Veronica Richardson. I'm here with my teammates, Jeremy Mosier, Anthony Valletta, and Alex Wilson, and we are going to take you on a journey to the story behind the numbers of Dropbox. Next slide, please.
All right, so a little background on Dropbox. Dropbox is a collaboration and file sharing platform that transforms the way people and teams work together. Some of the abilities of Dropbox is offering generous cloud-based storage space. They also offer powerful file sharing capabilities that allow seamless transfer of files that are typically too large to be shared via email. They offer unrivaled sync across all of your devices, your laptops, tablets, phones, so you can keep working on the go. You also have unprecedented control over access and the sharing of files. You can encrypt them when sharing. They have really useful file recovery features if you accidentally close out of something. They also have a really neat ability, doc scanning, to make software files from hard copies. You just take a picture, upload it, and you can get to work and collaborate on them. And they're all of this is designed for small all the way to enterprise level businesses or even individuals. So moving on to the business environment that Dropbox operates within, we did a SWOT analysis for all the environmental factors. One of the strengths, a couple of the strengths actually of Dropbox, is that they're one of the first companies in this space, really, even before Microsoft got into OneDrive, for example. So, they're pretty established. They have a very large amount of registered users, hundreds of millions of people using the platform. A weakness that we identified is that they seem to be a little bit over-reliant on organic word-of-mouth growth. So in the future, it wouldn't surprise us if they started to build out, an outbound sales team. An opportunity that we recognize is that remote work is becoming quite ubiquitous, especially under the current COVID-19 pandemic situation. And then threats, intense competition, and substitutes for their product. I mean, they're competing with the best of the best in the space. They're competing with Google. They're competing with Amazon, Microsoft, even Apple to an extent with iCloud storage. So definitely a tough environment here, competing for market share. So lastly, we're going to talk a little bit about their strategic plans, and you're going to see evidence of these strategic plans as we start to analyze all of the financial statements. I think that's one of the cool things about going through all the different statements themselves. So some of their plans are to actively develop new product experiences and extend the capabilities of the platform. They're going to do this primarily through two ways, continual R&D and development in-house, and then through acquisitions, acquiring complementary, services or companies that allow them to expand their capabilities and hopefully attract new users. They're also going to be pursuing additional intellectual property protection to the extent that they believe it would be beneficial and cost effective, because that, creates barriers through patents, et cetera. We're also going to continue to refine and provide industry-leading security, privacy, accessibility, and customer support. We believe that these are really the differentiators between, Dropbox and the rest of the competition. They do really well in those areas. And finally, maintaining and enhancing the overall brand. We want to have, the same kind of brand recognition of an Apple, Microsoft or Google at some point. That's going to bode really well for us. So without further ado, Alex is going to take us into our first financial statement, the balance sheet.
Hey everyone, yes. So let's get into the balance sheet here and talk about how Dropbox is financed to start off with. So the company is financed primarily by non-owners, which is not very typical for a tech company such as Dropbox, who are facing a very volatile market, have very large competitors in the space that could easily knock them out. If they are financed by non-owners, which they are, and their company, tanks, then they could be left holding the bag with all the debt. So high non-owner financing could be due to the company having a debt to equity ratio of 2.33, which, when compared to the average ratio of 2.0, it seems very risky to invest, and that's what that measures, is that risk. So if investors are looking at that measure, they may not be as excited to invest. Investors may be hesitant to place their money with a smaller company working in a market that already has such big players that are already competing for that market share. Owner financing is, however, readily available for them to start using. They have a significant number of available shares and very few outstanding. They've got 66.2 million available for issuance under the plans in 2019, and 2 million under the plans in 2019. So they've got a lot of room that they could use for growth. So this would maybe like help them get out of where they are now, which they're currently at 30% owner financing and 70% non-owner financing. So this should bring them out of that a little bit. The available stock types that they have are common stock, convertible preferred stock, and equity incentive plans that they could offer. Also, about their total stockholder equity, in 2019, they have 808.4 million, which is an increase from 2018, where they had 676.8 million. And they also have a solid amount of working capital at 228.4 million. So when there's an increase in the company's earnings or capital, all the time that results in an increase in the company's stockholders' equity. So let's move on to the next slide, where we will dive into assets and liabilities. Next. Okay, so for assets and liabilities, let's talk about the current ratio. So the current ratio really indicates the ability for companies to meet those short-term obligations. And if we look at the current ratio in 2018, it's 1.44%, and in 2019, 1.22%. And ideally, that would land between 1.5 and 3%. Now, while we've seen S&P is at 1.24, if you look in the tech industry, it's actually at 2.51, which is quite higher than what we see at Dropbox with 1.22. And one other thing to note is that it's actually decreasing. And when it's decreasing, that means that they have a reduced ability to generate cash. That's not ideal for their situation. Let's move on to the next slide. Okay, so short-term and long-term assets. Dropbox has significantly more short-term assets than their long-term assets, and this makes a lot of sense for their company. The short-term assets can be used for many things, including operating costs, financing salaries, acquisitions, and Anthony will actually touch on a lot of that in his cash flow statement. They also use those short-term assets to help extend their research and development in order to help compete with those players that we talked about earlier. And then sometimes they need to actually invest into long-term assets. Now, most of them are in short-term, but they needed to have a new corporate headquarters. And this was because their team was growing and they were running out of space in their previous office. So they needed to expand into that new space. Next slide. On to acquisitions. So Dropbox acquired HelloSign to help add to their tool set. HelloSign, very similar to DocuSign, they are a company that works on digitally signing contracts and documents. So now now Dropbox has that in their portfolio. The company has assumed a lot of uninvested stock that HelloSign had in their equity incentive plan, and the acquisition itself contributed quite a bit to the goodwill balance, which jumped up significantly from the 2018 numbers, which were 96.5 to 234.5 million. And that's 138 million increase. What they have seen is a lot of debt. They haven't seen a ton of profit yet, but we'll get into that a little bit later. Next slide. So if we talk about profitability and productivity, if we look at profitability or the return on assets, we can see that there's a negative 2.4% return on assets for 2019 and a negative 35% for 2018. And that's pretty large. Jeremy's going to touch on that a little bit later. Now, if we go into productivity or the asset turnover, we can see that they were generating 76 cents of revenue on every dollar of assets in 2019 and $1.03 for every dollar of assets in 2018. So it looks like it actually went down, but because that might be due to the fact that they invested in their new headquarters, and that's one of their investments alongside with their acquisition. And it'll be interesting to see how that pays off, and it seems to have not paid off quite yet. Next slide. So to come to a close here on the balance sheet accumulated deficit, we see that Dropbox incurred net loss of 52.7 million in 2019, 484.9 million in 2018, and we see these year after year net losses, and it'd be interesting to see why that is. So let's move it on to the next slide with Morgan.
Thank you for that. So now we're going to move into the income statement, but I think it's first important to talk about how revenue is generated at Dropbox. So revenue is generated via subscriptions, selling paid subscriptions to their services. The majority, the big bulk of Dropbox users are unpaid. They are free basic users. And so the strategy is to convert these unpaid users into paid users, either on a monthly or an annual plan, either as individuals or teams or even enterprise level for organizations. So that is how Dropbox makes its money and earns its revenue. And so that's an important segue. You can see here in this visual, two examples of plans that you can subscribe to. And that's a great segue into the actual income statement. So I already talked about the revenues on here and why that would be important to any organization or any manager. Also important is cost of revenue. So for Dropbox, that's any cost associated with maintaining the infrastructure, associated with providing their service and selling their good, right? So, or selling their service rather. And so we can see here, you take revenue and subtract cost of revenue and get your gross profit, and the number looks really good, right? 1.2 billion. But then as you look into our overall operating expenses, we are operating at deficit, and we have been, as you see, year over year. So it's important to note that while there, those are important aspects to look at it on an income statement, is what are your sales and what are your gross profits and how that's looking, and then but also what are your operating costs, and considering those things as you assess the profitability of a company. So I'm going to let Jeremy take it away and do some analysis of our income statement.
Yeah, thank you, Morgan. Super descriptive. I think that, a good thing to focus on now that we have sort of, a flavor for what these line items mean for Dropbox is, overall, how's the company looking, right? So you go across the years, 2017, 2018, 2019, and I know the first thing that jumps out is, one year just looks, really out of place. And that's 2018 with this huge net loss, $84.9 million. And why is that, right? If somebody was just happening to look at this without any background, I'm sure that would scare away a lot of investors. It made, Alex touched on ROA and AT up in the balance sheet, and those ratios were not looking too good, right? The story was bleak, but that's because of a one-time event. In 2018, Dropbox actually went public. They had their IPO, and because of that, there was a liquidity event. There was a one-time stock-based compensation of $418.7 million, and that spread across, a lot of the operating expenses as well as the cost of revenue. Depending on employees and, where their job functions lied, those salaries fell into different buckets, right? So, for example, employees whose main responsibility is the maintenance of these servers, things that relate to cost of revenue, some of that stock-based compensation would have been put in cost of revenue. So again, let's look at trends now. I think it's important to look at percentage of these line items, a percentage of revenue, as well as being able to see the numbers themselves. to basically help us visualize these trends. So as we can see, cost of revenue on the top portion of this statement, we see that it's rising every year, 2017, 2018, 2019, but it's becoming, less of a percentage of the overall revenue over time. It's 33% of the revenue in 2017, 28%, and then, 25%. So while the revenue is increasing, it's not increasing, as fast as our actual sales are. And I think that's a really good sign, right? You can see the same thing for net loss, our profit margin at the bottom here. It's, again, 2018 looks out of place at that negative 35%. But when you keep that in perspective and you see now in 2019, we're at negative 3%, we're well on our way, hopefully, to profitability, right? I think we're hypothesizing that without this liquidity event, all these numbers and figures for 2018 would end up being, squarely in the middle of 2017 and 2019. You can kind of notice this trend as you go across. So what's the story here, right? The calculated ratios might not be telling the full story. Just for example, we took a couple calculations, earnings per share, for example, negative 23 cents. That does not sound good, right? It's all things you need to keep in context of this liquidity event. It's really messing a lot of things up there. Our profit margins, as you already saw, were negative 35%, but then negative 3% in 2019. ROE, return on equity, was negative 5% in 2019. And is that out of place? I don't know. Many companies operating in the tech sector are valued more on potential than profit, right? So we need to keep all this in mind. Some good things, though, we have a high amount of revenue generated by overall a small percentage of users that pay for Dropbox subscriptions, right? So if we can convert these users, there's a lot of potential there. No single client accounts for over 1% of overall revenue. We thought that was very interesting, right? So you're not going to lose one client and lose a huge portion of your revenue. You're insulated from that kind of scenario. That would be catastrophic. Operating expense, particularly research and development, is extremely high, but that's sort of a given, for a tech company and for a company who states their strategic plan is to be expanding capabilities, right? So we expect the company to generate increasingly higher revenues from the, R&D department adding functionality and from strategic acquisitions. Our losses are partially offset by interest on our short-term marketable securities. Alex touched on how, we're long on short-term assets. And because of that, obviously, we're actually getting a little bit of interest as revenue. So for prediction for future results, if things keep trending the way that they are, we're hoping that, all these ratios are going to look a lot better, especially if we can, turn a net profit hopefully soon. So now we're going to go over to Anthony with our cash flow statement.
Thanks, Jeremy. So here we have the cash flow statement for Dropbox. As you can see, I kind of think the Dropbox's cash flow statement is sort of the best of the financial statements for kind of really explaining Dropbox's strategic plan going forward. So before we go to the next slide, I kind of just wanted to draw attention to a few line items in this cash flow statement. The first being the total cash flow from operating activities. It's been steadily growing over the past 3 years, as well as the purchases of short-term investments and the proceeds from short-term sales and maturities, the total cash flow from financing activities, and then the total cash at the end of the period as well. And all of these items, except for total cash flow from financing activities, have been increasing, have increased over the past year. And that might be alarming in terms of such a large decrease from financing activities, but we'll get into that on the next slide to kind of quell those fears. So next slide. Okay, so the first figure or the first line item that we want to look at is the total cash flow from operating activities, which, as we can see, is a significant portion of the firm's total cash flow at $528.5 million. So such a high operating cash flow is a great sign for a company like Dropbox in an ultra competitive market in the tech space, where you have competition, like we mentioned earlier, from titans like Microsoft and Apple. So this shows that they're buying their product, and the number of consumers is rapidly on the rise, as we can see that this operating cash flow has jumped by almost $100 million since 2017. And then the next item that I want to touch on is kind of the cash spent on short-term investment and the proceeds from those short-term investments as well. So as we can see, $775.4 million was spent on short-term investments in 2019, while $750.9 million was brought in through the sale or the maturation of short-term investments. So this shows that Dropbox, they want to be extremely mobile in the market space, meaning they want to be able to easily turn their investments into cash in order to capitalize on kind of the strategic plan that we talked about earlier, which is acquisitions of other companies or through the expansion of R&D. We actually saw this come to fruition in 2019 when they acquired HelloSign, and a lot of the cash used to purchase HelloSign was from the proceeds from these short-term investments. And then the next item we're going to look at is the cash flow from financing activities, which is the one area where we saw a pretty significant decrease in cash flow from 2018 to 2019, with cash flow being a net positive $300.8 million in 2018 to a net negative $176.7 million in 2019, which at first glance, obviously that's, a pretty huge swing, and might be pretty alarming to most people. But as we kind of dig deeper into the financial statement, you'll see that the reason for such a high net positive cash flow in 2018 from financing activities is due to the company going public in 2018 and having their IPO. From that IPO, they generated almost $750 million from issuing common stock. So you're obviously not going to replicate that the following year or ever again. And so with that, that's kind of the reason for the such a significant drop off. And then so looking at kind of the final bullet point, which is just kind of the total cash flow, we'll see that Dropbox, they have a ton of cash on hand, and they've been kind of increasing their cash on hand steadily since 2017. And this is, goes back to their strategic plan of they want to expand. They want to be able to acquire the new up and coming companies that they, target, that they think are something that would fit, that would fit under their umbrella. And they don't want to have to, go through any logistical issues of trying to get rid of long-term investments. They want to have the cash on hand and be ready to pounce when those companies and those opportunities arise. So like I said before, I think the cash flow statement is kind of one of their more promising statements, and kind of tells gives you a really clear picture of what kind of their strategic plan is for the future. So with that, we'll pass it back to Jeremy.
Thanks, Anthony. So before we concluded this presentation, I just wanted to share something with everyone that was very rewarding for our group. And that was at the end of putting together the presentation, it occurred to us that we hadn't even checked on how the company is currently doing. And it was super fulfilling to see that many of the predictions and hypotheses that we had made when poring over and analyzing the financial statements did in fact come to fruition. So in the first quarter of 2020 of this year, Dropbox posted its first quarterly profit. And that's amazing. They cited the impacts of COVID-19 as a possible reason for the earlier than expected profit. since more than ever now it's ubiquitous to be working from home. It's become the norm. And colleagues are working together in far-flung locations, and they really need capabilities that Dropbox offers, all of these collaboration tools and enhancing their work from home offices and having storage outside of their hardware. So the cloud storage has been great. Additionally, it appears that the acquisition of HelloSign did pay off. So these assets are working for us. The investments are paying off, right? The company cited a massive amount of signature service requests in January and February. And so I think I speak for all of us when I say that we were proud to have come to the conclusions that we did when analyzing the financials and then seeing our predictions really play out in real time. So thank you.